In the late hours of a restless week, as trading floors dimmed and headlines grew quiet, Russia's economy stood on the edge of something few were prepared to name. Currency screens flickered. Bond yields spiked. Phones rang across financial districts from London to Tokyo. Yet outside those rooms, the world barely noticed. No dramatic collapse. No single day of chaos. Just a slow, unsettling realization spreading among analysts. Something fundamental inside Russia was breaking, and it could travel far beyond its borders. How does an economy this vast begin to unravel without the world sounding the alarm? And why did so many choose not to look? This story is not about one crash, but about a dangerous silence. It's about warning signs buried beneath geopolitics, fatigue from past crises, and a global system that had learned to normalize instability. Investors across Europe sensed risk but hesitated. Policymakers exchanged guarded statements. Ordinary Russians felt the pressure first in prices, savings, and uncertainty long before charts confirmed the damage. If stories like this fascinate you, subscribe to join us as we uncover hidden global truths. And tell us, where are you watching from? Because the forces shaping this story may be closer to home than you think. Could this happen in your country too? Long before panic had a name, Russia's warning signs appeared in places few headlines ever reached. Regional banks quietly tightened lending. Import figures began to wobble. In provincial cities far from Moscow's glass towers, shop owners noticed suppliers demanding faster payments, sometimes in foreign currency. These were not dramatic events, just subtle shifts that suggested trust was thinning. For ordinary citizens, it felt like an unease without explanation, the kind that settles in before storms. At the center of it all was a fragile balance Russia had been maintaining for years. Energy revenues masked structural weaknesses. Foreign reserves projected strength. But underneath, the economy relied heavily on confidence that global markets would stay open, that capital could move freely, that geopolitical tensions would not spill into financial reality. When that confidence began to erode, it did so quietly, almost politely. In European financial hubs, analysts noticed odd movements. Russian bond spreads widened just enough to raise eyebrows, not alarms. Currency traders whispered about unusual interventions. The numbers didn't scream crisis, they murmured it. And in a world conditioned to react only to explosions, murmurs were easy to ignore. Especially when attention was fixed elsewhere: inflation fears, post-pandemic recovery, conflicts competing for urgency. Inside Russia, policymakers spoke in calm, measured tones. Stability was the word of choice. Control was implied. Yet behind closed doors, contingency plans multiplied. Emergency meetings stretched late into the night. The question was no longer whether pressure existed, but whether it could be contained and for how long. What made this moment dangerous was not chaos, but delay. A crisis unfolding slowly gives the illusion of time. And time, as history often shows, can be the most deceptive asset of all. As days passed, the signals grew harder to dismiss, yet still easy to rationalize. Russia's currency held its line barely. Market watchers pointed to interventions as proof of strength, not strain. State media emphasized resilience, reminding citizens of past storms weathered and survived. The message was subtle but effective: this was pressure, not peril. And for a while, many believed it. But beneath the surface, cracks widened. Corporations began delaying investments. Import-dependent industries felt the squeeze first, as payments slowed and contracts quietly renegotiated. For households, it appeared in everyday moments: prices inching upward, savings losing meaning, the quiet recalculation of what could no longer be postponed. These were not headlines, they were lived experiences. Beyond Russia's borders, reactions remained cautious. European banks reduced exposure in measured steps, careful not to trigger market signals. Asian investors watched currency data with growing unease, remembering how quickly confidence had vanished in past crises. In Washington, the discussion was framed as risk management, not emergency. Everyone sensed movement, no one wanted to be the first to say it out loud. This hesitation created a dangerous vacuum. Without a clear breaking point, markets drifted. Trust eroded without panic, leaving institutions unprepared for acceleration. It was the calm before a financial shift, one not driven by a single decision, but by accumulated doubt. The question was no longer whether Russia could stabilize its economy. It was whether the rest of the world would recognize the moment when stabilization quietly turned into something else entirely. The breaking point did not arrive with an explosion, but with a pause. Trading desks hesitated. Phones stopped ringing. In Moscow, financial officials gathered behind closed doors as numbers on their screens refused to behave. Interest rates climbed, not as a show of strength, but as a last attempt to slow an invisible exit. Capital was leaving not in panic, but in streams too steady to ignore. Across Europe, the reaction was immediate and instinctive. Bond yields shifted overnight. Analysts in Frankfurt and London compared notes, realizing this was no longer a domestic Russian issue. Exposure was scattered across pension funds, emerging market portfolios, and complex derivatives few fully understood. The memory of earlier global shocks resurfaced, and with it, an old fear: interconnected systems rarely fail alone. Inside Russia, the psychological shift was swift. Citizens who had trusted state assurances began converting savings, not because they expected collapse, but because uncertainty had become personal. Lines formed quietly. Not for bread, but for protection: foreign currency, tangible assets, anything that felt anchored. Confidence, once lost, proved impossible to recall. International institutions watched with growing concern. Emergency discussions floated possible interventions, yet political hesitation slowed every option. Supporting Russia meant risk. Letting events unfold meant contagion. No choice felt clean. And as markets sensed indecision, volatility accelerated. What made this moment dangerous was not scale, but timing. Global markets were already stretched, confidence already thin. Russia was no longer an isolated economy under pressure. It had become a test of how resilient the post-Cold War financial order truly was. And the world was about to learn how fragile confidence can be when it turns against itself. Once momentum shifted, events moved faster than language could keep up with. Currency defenses weakened despite aggressive interventions, and markets understood what officials could not yet admit: control was slipping. Each attempt to reassure investors produced the opposite effect, interpreted as urgency rather than confidence. Trust, the invisible glue of global finance, was dissolving in real time. Across Asia, markets reacted before dawn. Traders in Tokyo and Hong Kong adjusted positions as news filtered through fragmented headlines. The ripple spread outward: emerging market currencies wobbled, risk premiums jumped, and capital fled toward perceived safety. Investors were no longer analyzing Russia alone. They were re-evaluating the entire architecture of post-Soviet and emerging economies. One question hovered everywhere: if this could happen here, where else could it happen next? Inside Russia, the strain became visible. Businesses froze hiring. Regional governments delayed payments. The social contract stability in exchange for patience felt suddenly fragile. Citizens were not panicking, but they were preparing. And preparation, in aggregate, became pressure. The economy was being reshaped not by decree, but by millions of individual decisions made quietly, almost instinctively. In Washington and Brussels, the tone shifted from observation to containment. Emergency meetings multiplied. Financial safeguards were discussed in abstract terms, careful not to name the fear directly. Markets, however, did not wait for conclusions. They moved in anticipation alone. By the time the scale of the crisis was acknowledged, the damage was already global. What began as a question about Russia's resilience had become a referendum on modern financial interconnectedness itself. And still, the most consequential moment had not yet arrived. When the final rupture came, it felt almost anticlimactic. A decision announced in measured language carried consequences no one could soften. Russia's default was not just a financial event, it was a psychological one. Markets that had spent weeks guessing were suddenly forced to accept reality. Screens flashed red. Models failed. Assumptions collapsed alongside balance sheets. Across the world, the reaction was visceral. Hedge funds unraveled in New York. European banks scrambled to assess exposures they barely understood days earlier. In Asia, policymakers watched overnight capital flows with disbelief, realizing the shock had crossed every border without a passport. This was no longer about Russia's economy. It was about how fragile global confidence had become. Inside Russia, the meaning was quieter but deeper. Savings vanished. Trust in institutions fractured. For ordinary citizens, the crisis was not measured in basis points, but in postponed plans and altered futures. Stability, once promised, now felt conditional. What stunned the world was how quickly certainty turned into humility. The idea that modern markets could absorb any shock had been exposed as a comforting myth. Systems built on confidence had revealed their greatest weakness. And the aftershocks were only beginning to rewrite the rules. In the months that followed, the world did what it always does after a rupture. It adjusted, but it did not forget. Financial institutions rewrote risk models with quieter language and thicker margins. Governments spoke more carefully about certainty. Investors, once emboldened by speed and scale, learned to hesitate again. Russia, too, changed. The crisis hardened political instincts and reshaped economic priorities. Control became protection. Sovereignty became a strategy. The memory of vulnerability lingered beneath every future policy decision, influencing how the country would engage and disengage from the global system. Abroad, analysts would later describe the default as a warning shot that went partially unheeded. It foreshadowed future crises where faith would outrun fundamentals, where markets would once again believe they were smarter than risk. The lesson was available, but not fully absorbed. What Russia's debt collapse revealed was not weakness alone, but interdependence. A single decision in one nation could quietly recalibrate trust across continents. In global finance, confidence is the currency that matters most, and once shaken, it never returns unchanged. In the end, Russia's debt default was not just a chapter in economic history, but a quiet fracture in the story of globalization itself. It revealed how deeply the world had come to rely on trust in institutions, in promises, in the idea that markets could always self-correct. When that trust cracked, the shock traveled farther than money ever could. Long after currencies stabilized and balance sheets healed, the memory endured. A reminder that global systems are human creations, powerful, interconnected, and far more fragile than they appear.